Well, good morning, everybody. Welcome to the next financier webinar series. This is the fourth presentation in the series. Today's topic is financial due diligence, a banker's guide. I saw that we had just over 100 acceptances for today's presentation. So good morning to you all and thank you for joining us today. Just want to deal with some housekeeping this morning to get us started. So if you would like to submit questions in the questions pane on the right hand side of your screen, we will respond to all questions via email after the session concludes, and we will try to get through as many questions as we go during the session. The slides will also be made available today. We'll email those through to everybody. If you have any technical difficulties, go to that website there, support.goto.com/webinar. Doesn't help if your internet kicks out though, obviously. And post the session, we'll send you the slides, a link to the recorded session, access to past and future webinars, and of course, our contact details. So our presenters today, we've got Charles and Matthew. Good morning, Charles. How are you today?
Good, thanks, Andrew. Yourself? Hi, Matt.
Good. Tell me, Charles, could you perhaps introduce yourself to our guest today?
I'm Charles Haines. I'm an Associate Director up in BDO's Brisbane office, working in business restructuring and advisory services for 17 years this month.
Thank you, Charles. And Matt, good morning to you in Melbourne today.
Good morning everyone. Recently joined BDO later last year, although do have 5 years tenure with the firm previously and same amount of experience with Charles, and also a registered liquidator, having my track record in purely business restructuring for the last 17 years.
Thanks for that, Matt. And I see you're still at home. Not everyone's back to work yet in Melbourne CBD, I guess.
Yeah, so the restrictions are starting to lift, and about 50% cap this week. It should hopefully lift to 75% next week. So yeah, half of our team is forced to work from home at the moment.
That's not such a bad thing. And my name is Andrew Sallway. Good morning, everybody. I'm a partner in the business restructuring team here in Sydney. Some of you might remember me from the first session that we did on the impacts of COVID. I've been at BDO now for the better part of 5 years. Okay, let's get started. Here's what we'll cover today. I'm going to go through how you would go about setting a scope of works, including financial, operational, management, estimated outcome, and advisor fees. We're going to have a think about the impacts of COVID-19 on these sorts of engagements. We're going to go through very quickly 3 case studies that we think you might be interested in, and then finish off with the challenges and benefits of doing these engagements and how you can create value for your customers. So let's kick off with formulating a scope. Due diligence reports. They're called a wide range of things depending on what country you were born in, depending on what bank you work for. They cover things like, people call them IAs, which is an investigating accountant's report. People call them IBRs, independent business reviews. They can be called pre-lend reviews, and of course business reviews as well. But they all have something in common, and that is that it's a review for a financier so that a financier can understand the profitability and cash flows of the business and also understand how a business's assets are structured from a security perspective. And it's all about helping deal with a borrower, whether they're an existing borrower or a potential new borrower. And we're also importantly trying to identify any risks in the business and how they might be mitigated or are being mitigated by the management team. Now, Charles, when we're thinking about the scope of an engagement, how do you think different types of financing facilities can impact scope?
Thanks, Andrew. The type of facility that a financier is looking to put in place or looking to review will impact on the scope of works that's looked at. For example, a debtor finance facility will likely want additional analysis around debtor collections, right of set off, and liquid damages clauses in contracts. A trade finance facility may require additional analysis in relation to a business's stock turn, gross margin so they can better understand that part of the business. However, significantly, the nature of the facility will also impact the nature of the underlying business assets, which the financier will hold security. Generally, asset-backed lending is more secure and stable than a cash flow lend, with a cash flow lend scope typically being more heavily focused on the business's ability to service the associated debt and maintain the underlying business value. It's important to remember that due diligence is equally important at the outset of a new relationship, but also to assess what changes have occurred in a client's circumstances if it's a more mature relationship. Things to look at, regardless of whether it's an asset-based or a cash flow lend, is assessing what the value of the asset actually is. Now, for an asset-based lend, which could be real property or plant and equipment, this would generally be done by a valuation, whether it be land or plant and equipment. However, it's important to dig a little bit deeper in relation to the components which go into that valuation. A real property valuation could be underpinned by a tenancy. It's important to understand the term of that tenancy, whether the rent's at market rent, whether the property's fit for purpose, whether there's any environmental concerns which could cause an issue down the track, the classic example being a petrol station with underground tanks. For a cash flow lens, such as management rights business, again, a business valuation would be used to assess the value. But again, further insight doesn't need to be undertaken in relation to, is that value maintainable? What are the rights of customers to cancel contracts? What are the associated minimal notice periods required? And all this will come back to the assess the value and, of course, the importance of assessing what that would mean for the LVR and how much a financier is willing to lend. You need to consider, in the event that a financier needs to enforce its security, how it actually goes about it and what the impacts are. For example, for a yellow good, which is a relatively stable asset-based lend, what are the demobilisation costs from having those items removed from, say, a mine site in a remote location? Are there any environmental issues to consider in if they're moving through various regions? Again, for a cash flow lend, issues such as rights of entry, loss of clients, any particular legislative requirements, trust accounts, etc., which need to be considered, which could complicate and make more expensive securing the asset process. And finally, what are the competing priorities that exist that need to be considered? Are there any existing charges on title, whether that be land or PPSR? Do you need to consider whether a deed of priority needs to be entered into with an existing financier if you're only financing part of an asset base, for example, a debtor book? And for a cash flow lend, probably the most common question that comes up is, given the nature of the asset, do you need to consider the nature of the asset being a circulating asset with consideration to employee entitlements and the priorities they may be afforded under a formal winding up scenario?
Thank you, Charles. Sorry, there goes the slide. And Matt, the quality of financial information and the sophistication of a borrower's finance team can also impact scope, can't it?
Can definitely impact on the scope and then the cost of the engagement, and then probably most importantly, the quality of information then can ultimately impact on the quality of the conclusions that are drawn. And going through the examples we've got on the screen here, there's somewhat of a spectrum where at one side you've got externally prepared audited financial accounts, which are of the highest quality, and then you've got the company's internal management accounts, which may not have been fully reconciled, or they haven't necessarily followed proper accounting principles. So naturally then the externally prepared accounts take precedent over the internal accounts. That said, they're not always available. So you are quite often left to deal with the internal management accounts. If there's a positive though, those internal management accounts can often give you greater insights. You're able to drill down on numbers and see what the story is behind those numbers. And whereas with financial accounts, they are quite rigid. And then flowing on from that, the poor information flow or delays in getting those reports can delay the IA process, and the timeliness of responding to questions in response to those reports also then gets delayed. And if they don't have up-to-date financial information or is not as well organised as you'd like, then that reporting flow is inherently slow, causes inefficiencies with the process, and then also affects the cost. It's a particular nuisance when we're dealing with time sensitive engagements and there's a bit of pressure to turn around these sorts of reviews. And then on a separate note, the timeliness and quality of information can often tell you something about how well the organisation is run and just how organised management are.
Thanks, Matt. And if I was to say complication accounts are my worst nightmare, and what it normally means is, somebody's hit print on a mild report, and often, month-end procedures aren't followed, and so on and so forth. So that's what we mean by compilation accounts, and they can be terrible. Okay, thanks for that, Matt. Now, Matt, as we start to look in more detail at sort of scope of works, can you step us through some of the key points when reviewing financial information, please?
Absolutely. So often the last 12 months is a key time frame that we look at. That said, the prior 1, 2, 3 years of financial information is also very useful because they can tell you what's been changing in the business, what are their key drivers, and then quite often they hold the answer to what the business's problems there really are. And then continuing on that, looking at the trends, you can then see what opportunities there are for improvement. For example, if sales have dipped, you might then see that the variable costs haven't moved with those sales, and perhaps management aren't taking proper corrective action. And then more recently, a lot of financiers will be dealing with deferrals of repayments or requests to extend facilities, additional finance, and that might be off the back of, well, a common story would be the impact of coronavirus and the restrictions, how it's debilitated their business. So looking at these historical, most recent information will tell us if what they're saying is correct, if those losses are caused and do align with, say, government restrictions, or whether there's another problem and that story just doesn't work. And then that will help determine if that finance is warranted and the business will get back to where they say it will. Again, reliability of historical information is important, and then looking at some of those abnormal line items and how they should apply into the future. And then in particular, when looking at forecasting these days, we can't just extrapolate historical numbers because they might be inaccurate. They could include things like government relief or abnormal economic conditions due to restrictions. So talking to the forecast column, it's very important to validate forecasts. I'm not sure if any of our attendees were in one of the previous sessions where we went through that process in detail, but essentially it's a matter of making sure the key assumptions are reasonable. I've never seen a bad forecast, so it's important to drill down on those numbers. Are sales lifting? Why are they lifting? Are their margins realistic? What are the what evidence does the company have below that? So if sales are lifting by 15%, is there a contract, or what is the basis for that? And then in the forecasts, quite often in a distress situation, it's important to look at what the actual cash movements will be. Say if the company has a large project, what are the timeliness? What's the timelines for the receipt of money as part of that project? Rather than quite often what companies will do, and sometimes accountants, when they're preparing these cash flows, is they might just average out receipts and payments across the year. So looking at the actual flow of money when it's available, and then ultimately the purpose of this analysis here is to see if the financier can service the debt without sufficient cash flow available. With existing facilities, is it justified to have added facilities, temporary relief, that sort of question. and yeah, then to make sure it's not a case of the bank just financing a loss, or making sure that loss is only temporary. Yep.
Okay, thank you for that, Matt. I might just make a point on the historical side. We often get pushback, whether it be from the financier or from the borrower, on undertaking the analysis on the historical financial information. Typically, cost, or the borrower says, they've been audited, we don't need more accountants looking at it, or because the bank has seen them before. But I think some of the important points are us just making sure that the opening balances are right and they flow through to the closing balances are right and they flow through to the opening balances on the financial forecast, particularly with regard to cash, debtors, creditors, and statutory liabilities. And on, I think, the analysis of the historicals in terms of run rates, whether that be revenue, gross profit, debtor days and creditor days, that's very important. So as I say, we often get pushback on the historical side, and I think that those are some of the main reasons, as Matt has also covered. Okay, thanks, Matt. My computer's frozen. Now, Charles, we can also conduct a review of strategy and operations. What are the key issues when we're thinking about those issues for a financier?
Well, looking at the financial side that Matt's covered off on, will always be a key part of a review, but equally important is to look at the strategic and operational issues within the business, both internally and within its broader market. Looking at what the client's market position is in the market, identifying who the client's key competitors are, and also what the key opportunities are in the market. Are there key panels that the client is or should be a party of? Are there key qualifications that are required to undertake works, for example, government type works? Identify if the business is reliant upon key contracts, understanding what the terms of those key contracts are. When do they expire? Does the business have a sustainable pipeline to replace those key contracts if they are coming to an end? Looking at a strategic direction, does the client have a business plan? Is this a live document, or is it something that was drafted 5 years ago and is sat in the top drawer and no one's really given it much thought or consideration since? Has this been updated? Is it tracked in relation to current positions, and is it a live document? Trying to understand what the sustainable competitive advantage is for the client. Common responses at this are relationships, but then understanding what that actually means. Are these contractual relationships, or are they informal personal relationships? If they are more of the informal personal relationship, is this a key person risk that needs to be identified, and how is that risk mitigated if a key contact, let's say a client, moves on, or conversely a key staff member within the organisation moves? Technology is often listed as a competitive advantage, but what are the costs of research and development for sustaining that advantage, and has that been built into the cash flow that Matthew mentioned in his earlier slides? And unfortunately, a common response is price. People are competitive because they're cheaper than everybody else, but then drilling down with management, is this really a sustainable competitive advantage, especially in a highly competitive market? And then looking at the industry as a whole, what is happening in the market? We've seen over the last 12 months that all industries have been impacted by COVID, but there are disruptors throughout specific industries. Looking at rideshare operators, for example, have been a disruptor through the transport industry. Is management aware of these disruptors? Hopefully they are. What is their plan to defend the current market position, or use these disruptors as an advantage for the business moving forward? On the operational side, supply chains. This is something that's really come to the fore in the last 12 months, and probably moving forward in the next 12 months as supply chains, particularly international supply chains, have been disrupted. Some common examples have been in the building industry, where building contractors have had to source goods internationally, which have been delayed. because of international and domestic border closures, delays with transport. Now, these are having real impacts on contracts where they have deadline dates in contracts, liquidated damages which flow on, and what are the ability of those head contractors to call on those liquidated damages clauses. So systems and controls, what does the accounting function look like? Is it organised? Do they have the end of month processes that Andrew referred to earlier? Do they do regular bank reconciliations and end of month adjustments? Do they maintain separation of duties for key tasks, or does the same person authorise and pay an invoice? Personal and culture, what are the organisation's goals and objectives? Again, such with the business plan, is this a live document? Does it get updated as the organisation matures and changes? Are there key person risks within the business? If there is a risk, how are these mitigated through contracts of employment? Is there key people such as CFOs incentivised through the success of the business? Looking at the head office function, how does this operate if the business is spread over a large geographical region, domestically, internationally? One of the common warning signs for an IA in a stress situation is that has there been a change in key staff member, CEO, CFO? That may be a warning sign that there's a deeper problem that needs to be investigated. And what is the cost of the head office, and how is this caught in budgeting purposes? And what are the contribution margins that the operating divisions of a business may have to provide to meet these costs? Fortunately, we don't have to reinvent the wheel completely in these areas. There are some tried and tested analysis tools, SWOT analysis, looking at internal and external factors, strengths and weaknesses of the business, as well as opportunities and threats. And Porter's 5 forces, the top 3 bubbles really do deal with the competition in the market, whilst the other 2 bubbles deal with the bargaining power of suppliers and the bargaining power of buyers. It's not uncommon when you're doing a review to see that high concentration of customers that the business is reliant on. It's not necessarily a strength or a weakness, but it's something that certainly needs to be addressed by management in relation to identifying it as a risk and mitigating it where possible.
Well, thank you, Charles. Now, Matt, we often hear financiers say that that they are betting on management when they extend facilities. What work can be done to assess management in the conduct of our reviews?
Probably a fair comment, Andrew, because they're on the front line of the business and dealing with operations. So how well the operations and management how well the operations are managed will have a direct impact on the business's performance. We've got a range of questions that we often ask through the IA process, but we may not directly ask management, but what we do is we form a view on them through information gathering or interviewing the client. So we answer those questions indirectly, and that said, a very effective way to get a view on management is during interviews. And another technique that I like to use myself is doing workshops as part of the IA process. During that workshop or interview process, you'll get first-hand dealings with management to be able to form a view on these questions. They'll often have their finger on the pulse, and they'll be able to tell you, give you insights that the director might not be aware of, or give you information that the director simply isn't volunteering. So it helps you to get below the surface a little bit. And then side benefits of being involved with management through the IA process is if you include them in the process then and work alongside them, you tend to counter those adversarial personalities, which can be a challenge with IAs that Andrew will talk about a bit later. And naturally, if you've got their interaction and greater engagement during the process, then they'll let down the defensive exterior, and you can help get their buy-in. In particular, if you might see quite clear recommendations, but if you bring them on the journey with you and the client on the journey with you, then they consider those recommendations to be jointly designed, and therefore at the end of the IA process, rather than giving superficial credence to these recommendations, they've got buy-in and they're more likely to adopt it, and then will give the IA greater success in the long run. So that's the management process. And then
I was just going to say, Matt, I think for our viewers today as well, that, even if management due diligence isn't necessarily, a specific part of the scope, it's not uncommon for us to, and it doesn't appear in our final report, it's not uncommon for us to subsequently, provide our impressions verbally or via an email to the relevant financier around a number of those issues as well. Yeah. Okay. Thanks for that, Matt. And then, Matt, while I've got you, during our webinar on the 3rd of March, in a month's time, we're going to be looking at priorities in an insolvency situation, but sometimes we do get asked by financiers to prepare an estimated security position. Some people call them what do we talk about, an EOS, I think we call them in the BDO Sydney office. We all call them something different depending on which bank and which firm. But Matt, do you just want to talk about why we might be asked to prepare this for a bank?
Sure. So ultimately, when we're preparing an estimated security position, what we're doing is we're looking at the value of the security or the collateral in the worst case scenario. So in an enforcement scenario or a liquidation scenario. And essentially what an estimated security position is it's a rearrangement of the balance sheet. So rather than just looking at a simple form of the balance sheet and not knowing which assets are secured in priority to other creditors, what the estimated security position does is it takes those assets and makes it quite clear as to which creditors have priority over those assets in that worst case scenario. And then another important aspect is to put a realistic value on those assets. So in a worst case scenario, then what would goodwill be worth? Is that a reliable asset there for the bank's collateral? And talking about some of the important considerations that we've got up on the screen here, a very obvious example when looking at a estimated security position is that whilst the bank might have a circulating security interest or floating charge in old terminology, the employee entitlements will receive first bite out of those circulating assets. So if a financier is looking at debtor balances and cash balances and stock balances, thinking that, all right, well, we've got plenty of collateral there, although the estimated security position makes it quite clear to see, well, the employee entitlements will receive first benefit from the realisation of those assets. And perhaps a less obvious example would be PIMSs, which simply aren't on balance sheets, but are hidden in your unsecured creditor balances, perhaps. So a supplier, for example, will supply company stock, and it's quite common that they'll have a retention of title clause, basically saying that they retain ownership of those goods until they're paid for. So while a financier might be looking at a stock value thinking that there's good value underpinning their security, an estimated security position will go below that in a greater level of detail to see, well, which creditors would perhaps recover their stock in an enforcement scenario. What can the financier rely on?
Yeah. Okay, thank you, Matt. And just to finish off, Matt, sometimes we get asked to investigate some very specific issues that perhaps the relationship manager might have picked up, or might be industry gossip or something on a particular business. What are some of those other issues that we get asked to look at?
These other considerations, they can often be quite important, and they're not they can manifest themselves in financial statements, but quite often these sorts of issues aren't apparent. So, for example, if a company's got a poor track record with WHS and perhaps they're on the verge of being shut down, there's not going to be a line item in a financial statement to say that. So, looking at these non-financial considerations can be quite telling. So, customer contracts, for example, are there key customers that have contracts that are about to run out? Are they going to be renewed? Is there litigation that's just commenced that is likely to carry a large cost, or is it litigation over a debtor balance that perhaps isn't going to be recoverable? Statutory obligations, insurance can be important to drill down into, because a client might just turn around and say, yes, I've got insurance, but what is insured, to what value? Are the insurance policies based on old values? Has the business grown since then? And we've got foreign currency exposure and supply chain issues where particularly pertinent at the moment, where our overseas suppliers are having issues manufacturing goods. There's issues with getting them into the country because of restrictions, and then supply agreements. I know that Andrew's had some recent experience on this front that he can talk about, but basically these are all non-tangible issues that are important to look at. Would you like to share supply agreement experience?
Yeah, there was an issue on that I had recently with customer contracts, where we did a bit of due diligence around customer contracts specifically, because there was a degree of exclusivity on the products that were being brought into the company, and it was unknown how long, initially it was unknown how long that exclusivity was to continue for. And as we got in there and started to do that, there are a range of different contracts with different periods of exclusivity, and that was obviously important when you go back to the future forecasts and understanding how much some of those revenue lines were going to continue for. Yeah. Okay, thank you for that, Matt. So I might just move on to engagement costs, which can often be, in my experience, a difficult conversation for the financier to broach with us. Often when we're asked to think about how much an engagement will cost, we start with the scope and what that looks like. We'll ask to see the financial forecast so we can look at the quality of that. We'll ask about the historical information, how reliable it is. Is there an auditor involved, or an external accountant or an advisor involved as well? So I'll ask for all that information. I've worked on reviews in the last few years that range from a $10,000 review, where we're really focused on very specific assets and the quality of those assets and nothing more, through to a $1 million review that can last for as long as 12 months. There's many reports throughout that period of time. You're looking at a business that operates across many jurisdictions, across many states, as many different types of businesses, service businesses, construction businesses, and so on and so forth. And there's often complex legal issues involved. There's complex relationships between shareholder and the financier, or indeed many financiers involved. And also, typically in those sorts of situations, there's a looming crisis coming, and somebody's perhaps going to have to write off some money, or put in new money at the expense of, at a higher priority at the expense of other financiers. Typically, though, I'd say that our reviews at the moment are costing between $30,000 and $50,000. The typical scope, is not different to what we've discussed today, and there might be debt in those sorts of businesses ranging from $10 to $40 million. And I think the point that I would make, though, is that, again, our experience is that those reviews are for non-bank lenders, and they tend to be pre-lend reviews or IA style reviews, where they've been refinanced from one of the bigger banks. It's typically where that sort of work is going. I do want to make a point, though, about how engagement costs can change as we move through our analysis. And it's not uncommon, well, it is often the case that when we go into these reviews, both the financier and ourselves, we don't know what we're going into. There's a lot of unknowns. And as we start our investigations, we discover new issues and we learn about things that are going on with the business that we would not have otherwise have known. That's why we were sent in. But that then means that the scope needs to change and there's additional scope items, or perhaps things that we thought were important are no longer important to be considered. So it's important throughout the process that your advisor, hopefully BDO, is giving you ongoing feedback as to how we're progressing with our scope, how we're progressing with our timetable, and also if there's a need for the scope to change and whether or not that scope changes now or later. I mean, I can think of a recent example where there was, the information was handed over that, we aren't going to be able to make payroll in 2 weeks' time. That wasn't known going in. And so, of course, then the focus of the report changes because we're now thinking about short-term cash flow. What does the cash flow look like on a weekly basis for the next 2 or 3 months? How much money is needed? Why is it needed? Is it only going to be used to pay employees, for example? So we're always happy to have a conversation about engagement costs and to, come to us early with the scope. Sometimes we can help to refine the scope and weed out things that are important or not important and help to develop your scope as well. Okay, I might just quickly deal with the impact of COVID-19 on our reviews. The first point there is just some practical issues, and it's something I only came across yesterday actually on a pre-land review. We had a kick-off phone call with the management team and we just discussed what we would normally do, which is arranging a site visit, interviewing management, and then taking memory sticks out and sharing information. The CFO that we spoke to actually said, well, we're all still working from home, so you can turn up. There are people out the back working in the factory, but there's no one up front in the head office. There's no one from the finance team. So we'll be conducting all our interviews up for that engagement just via Zoom. It is what it is, and I think it's just, it's no different to Matt today, for example, working from home. I think it's the new norm. But some of the more meaningful issues that we need to deal with out of COVID-19 is that, it's so important, and we've said this in a number of our previous webinars that we've presented, the importance of management having a plan to deal with COVID-19. It's very unpredictable what's going on, whether we're going to be open or closed, whether that be local or international borders. Management need a plan for different scenarios, and to the extent that risks materialise, how they intend to mitigate or deal with those risks. COVID-19 has changed relationships with key stakeholders, whether they be suppliers, customers, employees, landlords, ATO and shareholders. Financiers and shareholders and the ATO are providing a degree of financial support. Landlords are either deferring rent or forgiving rent in some instances as well. Employees are stressed out. Some employees are working from home. Some employees don't know what the future of their job is. So one of the things that we are understanding in our reviews is how those relationships have changed and if there should be any concern about relationships. Number 4 there is, more than ever, the importance of having up-to-date financial information. And the reason for that is that it supports timely decision-making. We can't have a situation, looking at the second point there about, risks, can't have a situation where it's 3 weeks into month end and we don't have the financial results for January yet. It's important to know what the January results are, at least at a headline level, within the first few days of February. Made a point there about FY20 being an imperfect year. I mean, it will be the case that, when we go back and conduct our historical reviews of financial information, FY20 is going to look very bad. And when we start to think about, run rates, for example, when we're looking at forecasts, we need to have a degree of, support or understanding why FY20 was a one-off and that it is an abnormal. And then looking at, of course, if those earnings for FY20 can be normalised. And what all of that means is, points 2 through 5, is that you need a robust forecast. You need a forecast that's easy to be updated, a forecast that is being changed and updated every month, and something where the underlying assumptions are quite detailed, but can be tweaked as we go, I would say at least on a monthly basis, to ensure that the outturn for the balance of the forecast is as accurate as can be. Right, case studies. We thought just to come across and help bring some of these points that we've made today, bring them to light or bring them to life, we'd go through a couple of case studies. We've just selected some industries where we are doing reviews in these sectors, and some of the issues that have popped up might be relevant to the people on the call today. So Charles, I might ask you to go first and just discuss a recent one that you've done around labour hire and manufacturing.
This was a previous labour hire business primarily, but also did manufacturing as well, so it had multiple divisions. This was an insolvency-centric IBR in relation to the client had about 2 weeks worth of cash before it couldn't pay wages. Not the example that Andrew gave previously, but it's often a common case when an IBR is being undertaken. There is that level of stress in the business on the cash flow. The client had a mix of facilities. They had overdraft, trade finance, asset finance, business finance. The business had historically been unprofitable, but was growing rapidly. Management and the director believed the company would be profitable, but didn't have the financial accounts to support that. They were really going on instinct and how they thought the business was going. The business needed more cash to get over the hump before it reached profitability. So BDO were engaged and with the assistance of management put together a detailed cash flow, bringing together multiple divisions and consolidating a three-way cash flow for balance sheet, profit and loss, and cash flow. This involved going through significant numbers of equipment that was on hire and staff out on labour hire jobs. What this identified was that the current financial year would look relatively break even. However, that the business was on track to be profitable the next year. Certainly additional working capital was required to support it over the hump. The outcome for the financier was that the improved financial reporting gave them more faith in management. They actually lent more money, about the better part of $3 million in asset finance. In addition, a new financier was obtained for the debtor financing to deleverage the risk for the existing bank. Some key outcomes of the review were that the client was being overly aggressive on its equipment finance, which included equipment on essentially 2 years equipment finance, some on 3 years. However, these items had a 10-year useful life out on rent, which made them extremely profitable after the equipment finance came to an end, but the business didn't have the profitability to support the interest and capital repayments under that aggressive repayment schedule. Whilst the labour hire had been expanding rapidly and was profitable, the review identified that putting on an additional member of staff created an actual cash outflow of $20,000, and sometimes the client was putting on 20 staff a month. So whilst management couldn't understand at the beginning of the review why they thought the business and these contracts were profitable, they had no cash. Further analysis in relation to the labour hire cash flow identified those startup costs which management were not previously aware of. And good news was that the client eventually returned back to good bank and is still trading.
Well done, Charles. Thank you for that. I've done a few labour hire businesses myself. They can turn bad very quickly. Okay, Matt, a recent example on a wholesale distribution business. Would you like to talk us through that case study, please?
It's a good war story to share. We were engaged specifically to help with customer and debtor analysis. It was quite a narrative scope in narrow scope in relative terms. But what happened to the company was they suffered a one-off hit to their balance sheet with quite a substantial liability, and they weren't able to devise a plan on how they were going to recover from the situation, and that was really due to a finance function that was was lacking really. So we were involved to assist on that front. And I suppose it's a similar story to what we'll be dealing with quite a lot this year, where there'll be a lot of clients that have suffered one-off events to their balance sheets, such as shutdown of their business, or more recently construction companies not being able to get their workers on site down in Victoria. And so there'll be these one-off events that will make a balance sheet look terrible and historical P&L look terrible. But yeah, the question is, how is it going to recover from the situation? So we were brought in to help, similar to, because of the finance functions inadequacy, the sophistication of their system was also quite basic. So when we started drilling down on the operations and looking at how things can be improved, they really weren't able to give us any reports for us to begin with. And so what we're able to do in this instance, we're able to use data analytics to take big data, say 40, 50,000 rows of delivery information and sales information and just raw source information, feed that into our data analytics system and just create a heat map of the state. And what we had on that heat map was, the hotter the region was based on the value of the sales. So their best clients would be in red with the highest values of sales, and you could see the concentration on the state of where the deliveries were going. What became apparent was that you had these small value of sales that were in quite remote regions, and it was able to tell us quite quickly that, right, well, delivery routes in this region aren't profitable because there just aren't enough, there isn't enough product being delivered there. So with that in mind, there were a couple of routes that we simply went to damage control and stopped, and then there were other routes where they decided to focus their business development on. So yes, there's good clients there, but let's fill out the path on the way to delivering to them so that we can make that route worthwhile. Without data analytics, we would have just been looking at 40,000 rows in an Excel spreadsheet with postcodes, not knowing, what was going on. So it helped visualize that data, and then the client also had a very good understanding of what was going on, rather than us trying to simply tell him. We were able to show him. Similarly, we used analytics to do a margin analysis, and what the company thought were their best-selling products with the highest sales values actually didn't have the margin that they would have liked, and they were causing detriment to the business. So thinking that, this is our flagship product here, it's at the highest value, but the highest value of sales is not necessarily the best for the business's bottom line. So we're able to identify that, and the lever that the business pulled then was, well, how do we turn this around? Looking at the costs or sale prices, and it's quite common that businesses aren't thinking of their margins, or they don't have the system set up to be able to analyse that. And finally, another outcome that we were able to achieve was that we mitigated a lot of risk. We identified diversification issues with debtor concentration. We did due diligence on the quality of their documentation, so that if there are disputes, what evidence is there to stand by to say, well, this debtor should be paying, and essentially what that is what's the quality of the bank's collateral on that debtor, to make sure that can be recovered. And then overall, the business financial performance was improved because they were able to turn around those operations issues and performance issues, which improved the bank's security because they had a healthier business as a client. Then just finishing off with our key learnings, often directors are busy working in the business and not on the business, particularly in times of financial distress. They're going from one spot fire to the next. So a third-party expert can really help identify the issues, get the management and the directors to take a step back and see the forest from the trees, and work out where they're going. So another key learning was that rather than just being relayed certain information by the client, we're able to help the financier gain visibility of what's really going on with the business here, and what's the director not paying attention to. And then finally, the financier was able to learn that the reliability of that debtor, or that debtor collectively, the debtor balance was not as good as first thought, and so key steps were put in place to improve the quality of and reliability of those debtors.
Thanks, Matt. It's interesting how many conversations you can have with businesses about unprofitable stores or unprofitable products or unprofitable regions or whatever it might be. And management teams can't argue with their own data, can they? When you present it there and say this revenue is unprofitable, there's an emotion about giving up those things, isn't there? But they can't argue with their own data. Okay. I could quickly go through my example, which is contracting businesses. There's probably 4 or 5 that we've done recently, and these are an accumulation of learnings across all of those, including a construction business, a couple of printing businesses, a public transport business, privately owned public transport business, and mining services. And contracting businesses come up time and time again for review because it's really difficult to get your head around where the revenue is coming from. And when they go wrong, they go spectacularly wrong, particularly for the lender. And they're really, in many ways, just a cash flow land. And when you look at the revenue and the forecast cash flow, so much of that forecast is just blue sky. So it's projects or contracts that haven't yet been won. And so it's very important in our work, and why we're called in frequently, is to understand things like track rates and so on, which I'll go through now. So we like to look at and review historical performance. We look for volumes of work year on year, and also concentration of customers. Think about the pipeline that they have in place for new contracts, and the value of those contracts that are being tendered for right at this moment, at the time of our review. What's the value of the tenders today compared to, say, this time last year or 2 years ago or 6 months ago? So just to see if the business is tendering for new work and potentially growing or not. Understanding how much of the forecast, the financial forecast revenue, is blue sky, and what is the probability of that blue sky being actually converted into real revenue, and understanding within that list of pipeline which tenders are at the request for tender stage versus shortlisted down to 3 or 4 people versus perhaps the final step, which is that you've won it and you're just in the process of agreeing contracts. So that's very important. Contracting businesses, competition can frequently be high, and often contractors compete therefore on price only, and that obviously squeezes margin. So when you're looking through the pipeline of work, understanding what the margin is being forecast on that particular project as it relates to the forecast profit and loss statements, and is that gross profit that they're forecasting actually achievable, or is it the case that historically they blow out these types of projects, these types of installations, or these runs, or whatever it might be. Understanding if the business is growing and they're forecasting revenue to pick up, because projects like this are often milestone based. So you hit a certain milestone and then you bill. Billings might be every 3 months or 4 months or so on and so forth. And so the business will have to hold a number of working capital costs, employees, inventory, for example, until such time as they can get to that 3 or 4 months down the track and actually bill and collect the cash. So there's a working capital cost, and if the business is growing, there will be a working capital drain on the business. So we need to understand that. I always like to see, when we're looking at financial information of contracting businesses, that they can tell you the profit on each job. So we're looking to see job costing, not just the headline revenue number, but I'd like to see, as the project is ongoing, how much costs have gone into that project, and is it loss making or not at this point. And often when you go through that process, you'll see that a project is 75 or 80% complete, and they've made a profit on it up till that point, but the cost to finish will make that contract unprofitable. And then the question becomes, well, how is that future unprofitability to complete the project, how is that reflected in the financial forecast? It's very important. And then you have to understand how many of those are in the pipeline. CapEx spend, obviously, having yellow goods or heavy machinery in a lot of these contracts is important. And often that sort of CapEx will need to be ongoing if it's growing, or even just to replace what you've got on foot. And so that's important for a bank to understand the future CapEx requirements and how that's going to impact existing lending levels. And the last point I'm just going to make, of course, is contractors and bank guarantees. Often what contractors need to do is provide bank guarantees to the counterparty to the contract. So if the business is in growth, is there a schedule of contracts that are coming to an end and bank guarantees are being returned? Or one that I love is where contracts have completed, the business can go and collect the bank guarantee, but they haven't even bothered to go and collect them and get them returned back to the bank, which will obviously free up lending capacity within the business. Okay, that's the end of our case study. So thank you for all of that. Just going to reach some final points of conclusion, which I'll go through now. So pre-lends, IAs, those sorts of things. One of the key issues, is creating value for the customer. And what we find and what we say to businesses and to financiers is that, by going through an engagement with an experienced business professional like BDO, is that the management team will go through a process where their forecast, assumptions and methodologies are challenged. And I think what we find typically is profit and loss forecasts are generally okay, albeit the revenue line can be somewhat a bit rubbery. But businesses frequently fail to or struggle on how they forecast out their cash, their working capital, and their banking covenants. And by having us go through and challenge those, we can often help refine the forecast, not just for the current year, but also the methodology for future years. We'll often identify throughout our work areas for improvement in systems and procedures. And what that means is better reporting within the business, and that obviously leads to better decision making for the business. Another area also is sometimes these businesses will have a new CFO in the team, and the CFO is, often dumped in the middle of a year-end audit or an end of a banking facility that needs to be reviewed, and so they haven't had time to delve into overhead costs within the business and whether there's opportunities to reduce the costs. They haven't had a chance to delve line by line into inventory and whether there's inventory that's obsolete or out of stock or needs to be sold quickly for because it's out of season. And of course, the other one, of course, is debtors, and they've not had a chance. CFOs, for example, haven't had a chance to understand the debtor collection process and whether or not the business is doing the best that it can to collect cash from its customers. And the last point we'll talk about is value that we can provide your customers is helping with risks within the industry and within the business itself. Obviously, across BDO, we have a range of technical experts and industry experts with a very broad range of clients. And what we often do is, we'll defer back to another partner in one of those industries or skill sets and get to know, what sort of issues might be within the business and things that we should be keeping an eye open for. And if we find those issues, then we can defer back to that relevant partner and help us guide the bank and guide the customer in terms of how to mitigate these risks. So just to finish off, just deal with some of the challenges and benefits for financiers. I know how hard it can be for banks and financiers to find new business or to retain business, particularly in the current environment. Turning around and saying to one of your customers, look, we're going to get BDO in to do a review, doesn't always go down well. So it's important to obtain management buy-in to the process, and we can help you by doing that. So that and what we like to do is ensure that it's a positive experience for your borrowers or for your future customers. Part of that is the financier and BDO presenting a united front, showing that we're one team and working side by side. I think that's very important. And there's an overriding message that needs to be that this is not an adversarial process. We're often accused when we go into these situations by a CFO or by a director or something of, you know, being the bank's spy. And clearly we're in there to do a job for the bank, but you know, there are obviously benefits that come from that, which I'm going to address now. And one of them is maximising lending opportunities, which is the last point on the benefits slide. I mean, it is the fact that if you're calling in for a pre-lend review or an IA review, then there's something that's not understood. And there's something that's holding back new money or existing money staying in the business. And so the review can unravel or explain any issues that are out there. And that can help get through a credit assessment, either to get approved or in many cases to get funding outside of what would normally be approved within a financier's risk and credit. I've lost my words there. Risk and credit. What's the word there I'm looking for? I guess just existing lending criteria. Existing lending criteria is the word I was looking for. So part of the credit process is important for getting extra money. Another thing that we do, and we did mention this before, is giving financiers an assessment of management. And whilst it might not be a specific scope item, as we said before, we can give you our impressions of the management team, including their skills and their capacity to deal with some of the issues that the business is facing. And we can give insights into, you know, reasons for historical financial issues, identifying risks, and helping both the financier and the customer get facilities that match what the business needs. You know, it's not uncommon for us to do a review for a business that's looking for an overdraft facility or a fixed term facility, when what they really need is a trade finance facility or an invoice financing facility. So we can help understand that, and often that also helps to maximise the lending opportunities. So that brings us to the conclusion of the seminar. We're right on time. Just to recap, we went through some examples of scope of works, the impacts of COVID-19 on how we conduct our reviews, and we went through 3 case studies: a labour hire business, a wholesale business, and a contracting business. And we've talked through some of the challenges and benefits of these reviews for financiers and how we can use these reviews to create value for your customers. I just note that there's been no questions come through on the chat box. If you have any questions, please feel free to push them through now. While I'm waiting for that, I'd just like to thank my fellow presenters today. Charles, thank you very much, Charles, for your help today.
Thanks, Andrew.
And Matthew, thank you very much for your assistance today as well. Our contact details are there, and we'll also send through contact details via email together with the slides after the presentation today. Our next webinar is in 2 weeks' time on the 17th of February, and it's going to deal with tax issues in insolvency. It comes up a lot, financiers' exposure to tax liabilities when assets are being sold through an insolvency process, but also we're also going to talk about directors' exposure to potential personal liability in insolvency situations as well. And that's relevant because sometimes banks will have personal guarantees from directors or guarantees or mortgages over personal property. Okay, I see that there are no more questions that have come through, so thank you to all our guests for joining us today as well. I hope you enjoyed that presentation. Please feel free to contact myself, Charles, or Matt directly. We will happily attend to any email inquiries once they come through. And again, thank you to our co-presenters, and please all have a good day, and we'll see you on the 17th of February. Thanks, bye-bye.
Thanks, everyone.